Hello everyone. Today's recording will be on chapter 4. Chapter 4 is reporting financial performance. So that's the topic today. After we finish this chapter, we should be able to understand these three concepts that we are going to learn in this chapter. So when we're starting with the statement of financial performance, the report that what is a statement? First of all, what is the statement? The statement reports that measures the success of the company's operation for a specific time period has many names. So some of us calls a statement of income / earning. If it's an ASPE company, if the company is following an ASPE standards, they would call this report as a income statement, and IFRS has two versions of this statement of financial performance. When we say two versions, now they have two separate statements. First statement is called a statement of profit and loss. The second statement is called statement of comprehensive. So there in the statement of financial performance, they have two components, and that two components has a statement of statement of profit or a loss and a statement of comprehensive income. And then IFRS, the new IFRS conceptual framework combine this statement of financial performance into one statement. So that's what they did. They combined it into one statement. Now going forward, this is when they're talking about three basic business model, identify three activities. What are the three activities? They go on my statement of cash flow. So when we call it statement of cash flow, we're talking about three activities. These are the three activities we're going to be learning in details in chapter 5 when we create cash flow statements. The first activity they're talking about is financing. Financing is who's giving us money. So who's giving us money? So it could be the common shareholders, the preferred shareholders, or any long-term debt that is giving us money. Long-term debt could be a mortgage payable, bond payable, anything like that. Then when we talk about the second activity, it's an investing activity. When investing is when the company, as a company, where do we invest? So if the company is investing into assets, any long-term assets, in other words, the company investing in property, plant, and equipment, they could be buying an asset or they could be selling an asset. So that comes under the activities of investing. When we talk about operating activities use of an asset and people to generate profit. So what we use is we use assets. So we use assets to generate the profit. So anything that relates to current assets and current liabilities and your current year's operation will go under the operating activities. So those are the three business models that the book is talking about. Now, when in performing these activities, companies are exposed to different type of risk and opportunities. Of course, risk and opportunity comes together. So in order for us to gain something, we have to risk something. So at the time, the value, when we are going to the what is an optimal balance? Optimal balance is when you manage the risk, taking the right opportunity. So we have a risk, but this risk is related to taking the right opportunity. So if that happens, then the value is created, and then this is where we have an optimal balance. Now, when we think of it, of course, in a business or in a stock market or anywhere you think of it, greater the risk, the better the return. The greater the return, greater the risk. If you want more, if you want a high return, your risk is going to be high. If you want a low return, your risk will be low. So vice versa. So that's what it means. Different industries have different business model, and within industries. So now there's no one model that fits the one business. So every company has a different model. Every businesses, every different industry has a different model. So when we think of an overview of the model, so when it works in order. So what we're doing is obtain a fund. We obtain a fund from where? We can obtain a fund from externally, or we can obtain a fund from internally. So this is both places the money comes from. Once we obtain the fund, what we do is we invest that money. What do we invest that money? We buy the assets. We hire new employees. When the employees work for us, they generate more revenue. If we have assets, of course, we can rent out the assets, or we can use that asset to produce products. From there, the money goes into whatever the money we use to invest these assets in turn comes back, and we generate a cash and a profit. From that, the money that we generate in a cash profit put back into the business internally. So if anything comes internally is from the profit, another way of a retained earnings. And then we have two type of places where we get the money internally and externally. Externally will be the investors and the creditors. Internally will be putting the money into the assets, and that asset generating the cash and the profit, and then we use that money to make more money. Now going further, communicating information about the performance. The income statement helps users understand the business. Of course, why is it important for the investor? Why do we need to look at the income statement? Because what it does is helps users. What helps users do? Help them understand the business. So now, when we think of an income statement, it's just saying revenue, expenses, gain, and losses. So what an income statement does is evaluate the past performance and profitability. What it looks at the revenue, looks at expenses, looks at the gains, and looks at the losses. Compare the results with competitor. We can take the income statement. We are able to compare it to our competitors. The statement of financial position is also useful in assessing the profitability. Of course, if you think about it, what is an income statement? Income statement shows you how much profit the company made. So in that way, we know it is useful assessing the profitability. So now then the other thing that the income statement helps users understand is it provides them a basis for predicting the future performance. So of course, if you have information now, we can predict for the future. In the future, the performance could be good, could be better, could be good, or could be bad. But we can compare it. So what we could do is we can look at the information that we have it available now, and we can predict what we are predicting. We're predicting the future that hasn't been happened yet. Also, income statement helps users help them assess the risk of not achieving future net cash flow. Sometimes we set out to have a certain cash flow, and we're not able to achieve that cash flow, and then we can look at it. We can look at the advantages and disadvantages or risk, why we weren't able to get the result that we were supposed to achieve. Going further, when we are talking about quality of earning and information, the statement of income / comprehensive income has the following shortcomings. So of course, there's always going to be shortcomings. Shortcomings are sort of, in another way, what are some of the disadvantages. Items are excluded if they cannot be measured reliably. So what we cannot put it on the statement of income / comprehensive income. If we cannot measure something, we cannot put it on the statement. So that's the shortcoming, that some people might not be able to see the information because we were never able to measure it. If we weren't able to measure it, we weren't able to put it on the statement. Income numbers are affected by accounting methods used. So the numbers we use is the different accounting method. If I think of it, we could be using a straight line, or we could, for depreciation, we could be using a double declining method or a units of production. So the numbers that we arrive to comes from are affected by different methods. So your depreciation under straight line will be different, under the double declining will be different. If the company was following a CCA method, it will be different. The other shortcoming on these incomes, shortcoming when related to the statement of income, is use of estimate in measuring income. So when we have an estimate, we always have an uncertainty. Now, financial reporting is biased. Of course, internal people has more information than the external information. Sometimes the quality of the earnings have a shortcoming because the financial statements may be biased. Sometimes we follow GAAP for to look for some rules and some of the standards, and sometimes there is no solution there's no standard that we can apply, so there's no principle that we can apply, so then it's all about judgment. So that's what we learned in chapter 1. Going forward with the quality of earnings, there's two more main components we're going to be talking about in details. The first one is the content, and the second one is the presentation. Those are the two that we're going to be talking about in details when we are talking about quality of earnings. When we think of a nature of the content, unbiased and objectively determined. So what do we mean by unbiased? Means we wanted our, when we connecting the unbiased, we're connecting it to integrity of the information. So what we want it to be unbiased. The other one is reflect the economic reality. So whatever shows on our quality of, shows our statement of income, they reflects the economic reality. Also reflects the primary earning from the ongoing core activity. So the company's core businesses, it reflects the primary earnings on that. Can be correlated with the cash flow from operation. It can also be based on the sound business model. So the based on the sound models. Now, when we talk about presentation, we want to be transparent. Means we wanted to, everybody should have the same information. We don't want to mislead anybody. We do not want to discuss anybody. So that's when we're presenting our financial statement or statement of income, we want to be transparent. And then our presentation has to be understandable. Means this, if somebody is not an accountant, they should be able to understand your statement. Going further with the quality of earnings, when we are talking about a characteristic of quality of earning, the next one that comes in that we needed to talk about is earning management. When we talk about earning management, target earnings level and then working backwards to ensure the targets are met. So we have a set target that we are going to sell that many products, and then if you were unable to meet that target, then what we needed to know where we went wrong. So then what we needed to do to ensure we go backwards. So why did we set that target? If we set that target, then we have to go work backward to ensure the targets are met. So whatever target we set out to do in the future, we have to meet them. The selection of the specific accounting policies, use of aggressive assumptions and estimates. Sometimes we don't reach to those targets. The reason why don't we reach to those targets is because the management use aggressive estimates or assumptions when they're producing a statement of income. Presentation or results in the best light, rounding it up. So the presentation or the results in the best light. So the presentation has to be best. That's what it has to be best. Now, sometimes the earning management, the management that are managing the earning manager decrease the quality of the earnings. users should assess the quality of the earnings before making the decision. The quality is very important. Quality of the earnings, where the earnings are coming, the quality of the earnings are important before we invest into the company. So any decisions we make when we're talking about management earning, we needed to assess it before we make the decision. So sometimes what happens is that if you look at it, this one we didn't talk this point, increase income in the current years by reducing the income in the future year, or vice versa. So that's when you think of it, that's one way of management earning, is that we are try to manipulate. In other words, that's what we're doing, increase income in the current year by reducing the income of the future year. So that's what is earning management comes into play. How do we, when we talk about measurement of earning, how do we measure income? So there's a different way of measuring income. IFRS is different from the ASPE. IFRS generally supports the all-inclusive approach to measuring income. This results in comprehensive income. Now, when we think of when you up to now you have seen it, your statement of income is revenue minus expenses, or revenue minus expenses plus or minus any gains or other gains and losses. Those are some of the examples when I was thinking about it, that how do we measure the income. So comprehensive income include any non-shareholder transaction that cause a change in the equity. So whatever is in our comprehensive income, then it gets comprehensive gets closed out to accumulated other comprehensive income, and that accumulated OCI is other comprehensive income closed out to your accumulated other comprehensive income. This accumulated other comprehensive sits under the equity account. So everything gets closed out at the end of the year. Everything from the income statement gets closed out. So of course, if the comprehensive income sits on your other comprehensive sits on your income statement, they needs to be closed out. So what they're doing is it says it here, they closed out. Where they close out to is called an accumulated other comprehensive. OCI is other comprehensive income, and then accumulated is accumulates from one year to another year. Anything that sits on your balance sheet is accumulation. So we make the changes, add or subtract, and then that's the number that sits on your balance sheet. So when we think of other comprehensive income, what is other comprehensive income is made out of? It includes unrealized gain or losses on certain securities, or foreign exchange gain and losses. So if your company is dealing with foreign gain and losses, exchange gain and losses, those are unrealized. And other comprehensive income deals with the unrealized gain and loss. Also, we could have a gain and loss on the fair value OCI investment. So if you're investing income, if you're investing for a long term, and you're recording the asset at the investment at a fair value, it will go under the heading of fair value OCI investment. So anything that happens to that OCI, it could go up or it could go down. Anything that happens to that that investment, it is cleared out. It is recycled through the other comprehensive income. Now, there's some guidance are given to us how to under the IFR conceptual framework when it comes to other comprehensive income. All items of income and expense should be included in net income except under exception. So there's always exception. We should include all the income and expenses, but there's always some exceptional circumstances we're unable to put it in. So then there's a guidance that is available to us. In principle, all items should be recycled to net income as long as it is relevant information that is representationally faithful. So we have to be faithful when we're presenting it. Everything should go through the net income, but some item can go through your OCI. ASP continues to focus on the net income as the measure of the income. So other ASP companies, if you're following an ASP standards, if the company is following an ASP standards, they still focus on the net income. It does not. ASP, if the company is following an ASP standard, it does not have an OCI. OCI is if the company is following an IFRS standard, they have OCI. Otherwise, ASP companies do not have an OCI. Now this next one, we're talking about discontinuing operation. So we have two type of operation: continuing operation and discontinuing operation. So far what you learn is you have a revenue, you have expenses, then you have other gains and other gains and losses. And from there what we're doing is, this is the norm of your operation. So that will be your income from continuing operation. So when you arrive to it, you arrive to income from continuing operation. So the part we wanted to learn is, the part we wanted to do is we pay taxes after we pay our income, after we calculate the income from continuing operation. And the next step continuing is that your norm of your business is continuing operation. If something is discontinuing, it has its own separate component on our statement of income, our statement of or an income statement. When we think of a discontinuing operation, it includes separate components that have been disposed of or held for sale. So we're going to be, if a company has company has a segment, or company has a subsidiary that is not doing well. So what we needed to do is we needed to close that subsidiary. So then when we close that subsidiary, we call it discontinuing operation. The components of discontinuing operation, there's under ASPE, under IFR. Discontinuing operation comes under both ASPE standards and IFR standards. So when we think of from ASPE point of view, an operating segment reporting unit, what is a discontinuing operation? Discontinuing operation is a reporting unit, subsidiary, asset group, or operation without assets. If you don't have asset, of course you're not going to generate any revenue. If you're not going to generate any revenue, you're only going to have an expense. So if you're going to have all the expenses, you have a loss from that operation. So that's why it's called a discontinuing operation. So that if you have a loss, you no longer can generate any income. So what happens is, all the assets that you have in that discontinuing operation, there will be sold. So they will be sold, or they're held for sale. So under the IFRS, some major line of a business or geographical area of operation or a business qualify as a held for sale upon acquisition. So discontinuing operation is presented separately. It's not part of the continuing operation. It's part of your discontinuing operation. When we think of it's like we're talking about it here, the business component must have an operation. In order for it to have a company, the business component must have an operation, cash flow, and financial element that are clearly distinguishable from the rest of the enterprise. So we have a continuing operation. That's the norm of that business, of that company. There's called a continuing operation. If it's not related to the continuing operation, then it becomes another component itself on our financial statement. It's called a discontinuing operation. Separate financial information is critical, so the gain and losses from the discontinuing operation can be measured. So why we keep it separately from the continuing operation? The reason why when we're doing a discontinuing operation is so the audience or the investor or the creditor knows that the discontinuing operation is only for the 1 year. When they compare their financial statement, they know that discontinuing operation is not there all the time. So it's only there for that particular year. The following year, the company is not going to have a discontinuing operation because they're not going to be closing the divisions every year. So that's why you keep it separate from the continuing operation. When we talk about held for sale, what do we held for sale? You have asset held for sale. So if you're discontinuing operation, whatever if this is my division and I'm closing that division, what we have is the first thing you're going to think of it, you're going to have a gain or a loss. You're going to have not gain and loss, you're going to have an income or a loss from discontinuing operation. So you have to keep your discontinuing operation separately. You could have an income or you could have a loss. So then you will say that why we're discontinuing if the company only has an income. Sometimes the company the company has an income, but that income isn't enough to carry themselves. So then some of the expenses are paid by the parent company. So that's what happens. So if that happens, that we know that the company is not going to perform well. That subsidiary is not going to perform well later on. So the company could have a loss or an income from the discontinuing operation. Then you could also have a gain or a loss on a sale of an asset. So what happens is, if we were discontinuing our operation, we have to sell all the asset. When we sell all the asset, we could sell it for more or we could sell it for less. Under the discontinuing operation, you're going to have two items all the time. So income or loss from discontinuing operation, or you could have a gain and loss on the sale of an asset. So when we think of any asset, that what does asset held for sale qualify? What is the component? If the component is not disposed, if the asset is not sold, then they're kept under the heading of held for sale. Those, if they're held for sale, those assets, we cannot take depreciation on those assets. I think they will say it. Depreciation is not recognized on the assets if they are not sold. If we're keeping them for held for sale, that means we're not using it into the business. We're not using it in the business. We cannot take a depreciation of that. Now, the held for sale the other definition, the other criteria for held for sale is that the assets are available for immediate sale. So if the buyer comes, we can sell the asset immediately. Active search for a buyer. So we're always looking for a buyer to buy our assets, the assets that are held for sale. Sale is probable within a year. So when we put the asset under held for sale, we probably will be able to sell that asset within a year. Asset has to be reasonably priced and actively marketed. Means you have to have advertising. That's what market is. Change to the plan are unlikely. Once we decide to disclose, when we decide to have this asset held for sale, we cannot change our mind saying that we decided not to change it, because you already classified that asset as a held for sale. You cannot change your mind on that. Remeasure at a lower of carrying value and fair value net of cost. Some of the assets that when we talk about the presentation, some of the assets that are held for sale, we might need to remeasure at a lower of carrying value, and when we're comparing the carrying value and the fair value, we might have to remeasure it so that at a lower cost. Once the assets are written down, subsequent gain can be recognized only up to the amount. So any asset, so what we do is we could have a gain or we could have a loss. So if we have a gain, we can only record a gain up to that loss. We cannot create an extra gain. So only going to be up to that loss. So whatever our loss was, so if our loss was $1,000, our gain can only be recognized up to that loss. So up to that 1,000. Presented separately on the balance sheet. When the assets that are held for sale, they're not part of your norm assets. You could be having current assets or a non-current asset. They have their own heading, so you cannot include them into your current and non-current assets, because they are classified separately. So now this is a sort of an example of how your income statement will look like if you have a discontinuing operation. you have seen it up to this point. So you have seen it from this point where you have done it revenue minus expenses plus or minus any other revenue and expenses, and that's where you have a income from continuing operation. Now this part we just did it today, discontinuing like operation, like I told you. Then we have two things when we have discontinuing operation. We pay taxes on the continuing operation. They didn't show you here. We have an income tax that we pay from the continuing operation, and then anything you deal with it after that point is always going to be net of taxes. So anything you do from that point will be net of taxes. Now you could have a loss or you could have a gain on an operation, so or income, sorry, not a gain, an income. So you could have a loss or a gain on an operation that is discontinuing. So you have a loss or you could have an income from discontinuing operation, and that has to be reported in a net of taxes. So net of taxes means that we pay the taxes at the top, so we do net of taxes. So now there's two things can happen. If the company has an income from operation, the company can, I'm just making up the income, the company's income was 1,000. Let's say they were in 20% tax bracket. So when you're reporting this income, you're going to report this number will be 20% of that will be 200, and then it will be $800 is your net income from the discontinuing operation. When you're reporting it, you're going to report the 200 here, 800 here, total was your 1,000. So anytime you show your discontinuing operation, it's always shown net of taxes. So it's always net of taxes. You could have a loss or you could have an income. When you have a loss, it's called a recovery, tax recovery, and then when it's an income, then it's called a tax we pay. Same thing, disposal from a loss or gain from disposal of division's equipment. So any asset that we sell, you could have a gain or you could have a loss. That's why I said that you're only going to have two things here, gain and loss, income of loss, but both things needs to be reported net of taxes. So once you do that, then what we do is we come up with the net income. From the net income, then the next thing, I think the question is talking about it, is we're going to talk about later on too, earning per share. Earning per share is calculated at three places. First place is continuing operation, the second is your discontinuing operation, and the third one will be your net income. So earning per share calculated at three places. Earning per share is calculated income from continuing operation, income or loss from discontinuing operation, and the net income. Those are the three places that the earning per share is calculated. So now going forward with the presentation, this is the basic requirement. In other words, they're saying you have a revenue and you have a income from investments, you have an income tax before the discontinuing operation, and then you have a discontinuing operation, and then you have a net income. So they just showed you it's sort of a clear picture. But then the only thing is difference between the both is where under IFRS we have other comprehensive income, which is your unrealized gain and loss, or any fair value OCI investments goes to your other comprehensive income. Now going further with your presentation, now these are some of the examples they're showing for the continuing operation. Every business financial statement will be different. So item included in continuing operation, revenue and expenses, of course, gain and losses. Any unusual gains and losses means that if it's not, it doesn't happen every time. So then it's unusual. So that not a typical, not frequent means it happened 1 year, it might not happen in the second year. Some of the examples of those unusual gain and losses are included here. Write down of an inventory, marker crash, we have a foreign exchange gain and loss. Those are some of the unusual gains and losses. Now the next, so of course, once you do that, you have a continuing operation, then you have a discontinuing operation, and any other items that are material or relevant to understanding the financial statement financial performance presented separately. Anything we needed to show our investor and creditors, we will show them. So now the part I wanted to do is this is sort of a consolidation earnings. So that means company has to probably have a subsidiary. So what they have is they have a revenue and gains, and then they have a recovery of the taxes. So now this is sort of, we are doing compared. In this example, Onyx is showing a comparative financial statements, because what they wanted to do is you should be able to compare it. So if you're investing in 16, the company has a loss. In the 2017 they had an income. You can see it, they had a bigger profit. If they had a bigger profit, you wanted to know where that profit come from. Is this profit is going to be staying with us for the 18 or with the 19? It's very important when you're looking at the financial statement, because when you want to invest, you wanted to invest if the company is progressing well. Now, under IFRS, the statement of comprehensive can be presented either as a single combined statement or two separate components. So you can combine it, or you can do a single. So companies have a choices of doing it combined or separate. So in this case, if they do a single combined statement, it will have a revenue, expenses, gain and losses, net income, other comprehensive income, and other comprehensive and other comprehensive income. But sometimes what we needed to do is we don't want to combine it. So that's the traditional sport, the two separate statement, traditional income statement and another statement beginning with net income, adding the other comprehensive income. So it depends on what the company wants to do. There's no one standard is better than the other, or one statement is better. Some companies use a single, and some uses a two separate statement to show this to their investors. I mean, they even say it does not require the use of comprehensive income or other comprehensive. It's not required, but some company just wants to see it. So now, if you look at it now, if in this case they showed in this example, I just want to bring to your attention, even though we're now working out the earning per share, like I said, that there now you have a basic earning per share, diluted earning per share. Those are calculated. You will be learning a little bit more into when we're doing diluted earning per. What if they were diluted? I believe it's in chapter 17 of your volume 2. If you wanted to see chapter 17, I have a recording on 17, which is volume 2, chapter 17. I believe has diluted earning per share. What if something was diluted, and how to calculate them. So that's what I just wanted to point out, that what are the basic earning per share. Basic is what we calculated, and if it's a company, it has some of their debt, it can be converted into shares. Then we have to calculate diluted earning per share. ASPE company if it's a company is an ASPE company, there's no requirement for them to calculate that they have to calculate earning per share or diluted earning per share. But IFRS are required to have to calculate the earning per share on their financial statement. So they're required. So now, like, we talked about a little bit about single step and a multi-step. So when we talk about single step, it's presented only two groupings, so revenue and expenses. So all the revenues are grouped together, all the expenses are grouped together. So that's called a single step. So we don't have different column for different type of revenue, different type of expenses. You can have selling expenses, administrative expenses, sales type, like different type of expenses. There's no difference between those. Everything is put it in together before the discontinuing operation. And once you have a revenue minus expenses, you have a income, and that income you're going to pay taxes on it, and that becomes your income from continuing operation. So that's what That's what you have learned up to now. Now, what is the advantage of doing it a single step? It is simple. It eliminates classification problem, because sometimes we classify the expense under selling, sometimes we classify them under administrative. So it eliminates that classification problem for the revenue and expenses, because we group them together. Now, if there's an advantage, of course, there's going to be a disadvantage of doing a single step income statement. Now, oversimplification means it's too simplified. There's not enough detail, so that I don't know what is current and what is non-current, so what is operating and what is non-operating. So it's hard to tell what you're doing. So if you look at it, this is an example of a single step income statement. So if you look at it, they have a lot of notes. If I want to know what is this in revenue, I have to go to note 15. If I want to know what are some of the expenses in human resources, I need to go note 21. So when you simplify things, sometimes it makes it harder because it's oversimplified. Now, multi-step income statement takes longer. If something takes longer, of course, it's going to be costly for the company too. So multi-step income statement what we have is we separate. What do we separate? Our operating activities from the non-operating activities, and we match the cost and expenses with the related to those revenue. Of course, we follow the matching principle when we're creating our multi-step. So we match the cost and expenses. What do we match it to? The revenue. The advantage of multi-step income statement is highlighting regular and irregular items. Regular is going to be there every year. Irregular is going to be there once a year. Allows for a greater predictive value, assess the future earning, and feedback value. We learned in two values that our financial statement provides us. So we have regular and irregular activities. Multi-step gives you that. Provide better detail to compare the companies, so we can compare each expense with the other company or other detailed information. Allow for better ratio analysis to assess the performance. So if somebody's performance is dependent on these ratios, and if you have a multi-step income statement, what it does is it's provide better ratio analysis. Now, sometimes what we have two set of we have two set of statements. One we use it for internally, and one we use it for externally. So sometimes some companies, when they have statements, they have a two set of, one they use it internally and one they do it externally. So when the multi-step income, when you have a multi-step income statement, what goes under the continuing operation and what goes under the discontinuing operation. When we think of a continuing operation, the first part of the continuing operation is the operating section. So there's two sections, in other words, operating and non-operating. In the operating is the report of revenue and expenses of the company's financial operation. So anything relates to the operation of the company, it goes under the operating activities. Under operating activity, we could have a sales, or we could have a revenue. If you're buying and selling, we could have a cost of goods sold, and we could have a selling expense, and we could have an administration or general expenses. So those are the goes under the current operation of the business. If it goes with the current, it goes under the operating operating section. So the non-operating that's not the current operation. In other words, a report of a revenue expenses results from the company's secondary or auxiliary activities. In addition, special gains and losses that are infrequent or unusual are reported in this section. Anything that is not the norm of the business, that goes under the non-operating expenses. In this case, there is two that are non-operating. One is other revenue and gains, and the other one is expenses and loss. So those are the two headings under the non-operating expenses. So of course, we have a continuing operation. Under there you have operating and non-operating, and then once you add both of them, you have an income from continuing operation. After that, you pay your taxes That's your part C. You pay your taxes, and you are then the next part is discontinuing operation. Under the discontinuing operation, like I said before, they're always going to be net of taxes. You're only going to have two items under the discontinuing operation. You could have a gain and loss of a disposal of an asset, or you could have an income or loss of a discontinuing operation. Other comprehensive income only by IFRS, and anything that related to fair value OCI investments, and anything that goes with foreign investments or foreign exchange, they go under the other comprehensive, because they are not recycling. They are not recycled through the gains and losses here. They are recycled through the other comprehensive income. Now, the next type of a statement is a condensed income statement. When we talk about condensed, just the word itself is condensed, right? Expenses are reported on the income statement in the group total. So there's a group total, they're condensed. Detail of the expense groups are included in the supplementary schedule. So now there you have a expense, and this expense they put at $1 million. So this $1 million, what they do is they have to provide you a supplementary schedule to show what are the name of some of the expenses and what are the amounts. So I'm going to show you here. Then when you think of the other expenses, what they're going to do is they're going to in your condensed statement, they're going to show one. So if you look at it, yeah, it did show it. It showed one other expenses, 643,273, and then there they put in a note. So what you had to do is you had to go and see what this 643,000 made out of. It made out of depreciation, amortization, other personal and related expenses, and foreign losses. So in other words, if you have a condensed, when you have to provide a lot of notes for the users to see if they can break it down to what each expense is for them. Provide the advantage of to be concise, understandable income statement. Some investors like condensed income statements. It reduce the information overload. So if I were to put in all those expenses in the body of the income statement, sometimes you system overload because there's too many expenses. So sometimes it's simple is better. So that's what it means. Now going further, it's saying under IFRS, analysis of expenses must be presented based on either nature of the expense or the function of the expense. So when you're presenting any expenses, so we talk any expenses that are presented, when you're grouping them together, you have to group them together with the nature versus function. So when we talk about nature of expenses, you have purchase material, transportation costs, employee benefits, and depreciation. When you have function, what is their function? Cost of sales and administration is some of the example of the function of some of the expenses. The choice now, do we put it under function or do we put it under the nature of the expense? That is, choice should result in the information that are more reliable and relevant. So when we are deciding, should we put it under the nature of the expense or should we put it under the function of the expense? It's everybody's every company is different. We needed to put it in when we're separating them. We should separate them from the point of view from the reliability and the relevant. So when we look at the reliable and relevant, when we are grouping them together. No, there's no guidelines under SP. There's no guidelines. Only under IFRS, this expenses can be separated. Which method is better? It doesn't matter. There's no one better than the other. Depends on how most companies use some combination, some both. So depending on the company itself, there's no one better than the other. Now, when we talk about intra-period tax allocation, this is all about taxes, and you are going to learn in chapter 18 where we have a deferred taxes or future taxes. Refer to the allocation of income tax within a period relates to the income tax to the item being taxed. Certain irregular items on the income statement are reported net of taxes. Of course, what are the items that are reported at net of taxes? Discontinuing operations are reported at a net of taxes. So that's the other thing. So now income from continuing operation, you pay the taxes at that point. Discontinuing operation is a net of taxes. Other comprehensive, although IFR allows for the either net of taxes or before taxes. For most company, what they do is they show it as a net of taxes. So most company wants to be consistent, because if they show discontinuing net of taxes, they like to show this as a net of taxes. But there's no regulation. There's no standard behind although IFR allows for either net of taxes or before taxes, which one amount shown for tax related to all the items. So they allow you either one. So there's no one better than the other. The next part we're looking at is your earning per share. When we're looking at the earning per share, is as a shareholder, you want a piece of the pie. So every share you own, you want part of that income that the company made is your earnings. So earning per share is considered a key indicator of a company's performance. If the company made an income, or company has a net income, they're going to pay they're going to pay a dividend. And then if they're going to pay dividend, that's what's called a share of the pie. So then if the company needs to perform well in order to pay out their shareholders, indicate dollar earned per common share. It does not report the dollar paid. So indicate dollar earned per common shares. It's earned, means they should be going to common shares. In order for them to get paid, the company has to declare the dividends first before it can be paid. If the company did not declare anything, earning per share is just to tell you that that's how much they should get. How much, if you own a share, you will get $5 per share if the earning per share was $5. But what you're going to get in your pocket depends on when we declare the dividend. So that's what happens. Earning per share is an indicator, but it's not that the company has to pay. Sometimes they want to retain that profit. If they want to retain that profit, they will not be declaring any dividends. Earning per share, like I said before, it's calculated three places based on the earning before discontinuing operation, earning per share on the net income, and on the so there's three places: income from continuing operation, income from discontinuing operation, or the third one is a net income. So those are the three places that the earning per share is calculated: earning per share, continuing operation, discontinuing operation, and third one is at net income. How do we calculate earning per share? You've seen this formula, but I'm going to show it. Net income minus any preferred shares divided by weighted average of common shares outstanding. We have common shares outstanding. Now we're changing that formula. We're changing into weighted average shares outstanding. What do we mean by that? Is that some shares are not outstanding for the full year. If they're not outstanding for the full year, we need to prorate them for how long they're outstanding in order for us to calculate the basic earning per share. So in this case, when you have you have two type of things. We are going to have a basic earning per share, and then we're going to have a diluted earning per share. So then what happens is that this earning per share can be diluted with certain things, can make this earning per share go down. Dilution, again, it's in chapter 17, diluted earning per share. The full chapter is on dilution earning per share. For both situations, both basic earning per share and diluted earning per shares are presented. If the company, normally what happens is, if anything can be converted into shares, we use a what if method to convert that bond or those shares common shares. So if you have a bond, and with that bond there is that bond can be converted into shares. If that can be converted into shares, you need to consider it when you're calculating your diluted earning per share. So that's we're just going to talk about briefly what are basic earning per share. Basic earning per share formula is net income less your preferred dividend divided by weighted average shares outstanding. This basic earning per share can be diluted further because some of the securities that we have in our balance sheet, they can be converted into shares. If they can be converted into shares, then we have to calculate the diluted earning per share too. Now, like I said, that ASPE does not require any disclosure on earning per share. They don't. Private companies do not even calculate earning per share, so they don't even calculate it. Now, going further with our calculation, with our theory is that retained earnings. So, of course, when you create a statement of income or income statement, anything that is on that income statement gets connected to the retained earnings. So, net normally you learned it beginning retained earning plus or minus your net income or net loss minus your dividend declare is normally the ending balance. Sometimes we needed to readjust our beginning retained earning because if there's a correction of prior period, we call it prior period adjustment. And sometimes what we needed to do is we made some mistakes, or we have a correction that not belongs to the current year, belongs to the prior period. So we needed to retrospect or restate our retained earnings. So like that, any changes that belongs to the prior years, and they should be adjusted. That should be adjusted through the retained earning. If they should be adjusted through the retained earning, then we needed to do a prior period adjustments. Where the prior period adjustment come from? It comes from changes in accounting estimate or change in policies, or sometimes what we do is we omit something accidentally, and then we needed to adjust our retained beginning balance of our retained earning. Now, if prior period statements are now restated opening, now sometimes what we have is we have time to go restate our last year's income statement. It means the books are not closed, we can restate it. If that's the case, then whatever needs to be done, we fix it. If that's not the case, then if the prior period statements are not restated, the opening balance of the retained earning will be adjusted. So if you made a mistake in 16 and then the books are not closed for the 16, you can go back and fix those corrections. If you are unable to, if the books are closed, you're unable to fix that, then it will adjust. You have to adjust your beginning balance of your retained earning. That is called as prior period statements are now restated. Opening retained earnings would be adjusted for that, and it's all what goes on to your retained earning, net of taxes. So if net of any correction you are going to make, it will be net of taxes, because either retained earning is going up or retained earning is going down, depending on what the prior period errors are. Now, this is an example of a prior period adjustment. It's saying that the beginners balance January 1st as reported. So this was the balance they reported. Ending of 1 year becomes the beginning of next year. But we have a prior period adjustment. In this case, it was an inventory adjustment. Inventory adjustment. Sometimes every ending of one becomes the beginning of the second year. They adjust themselves. If it's not adjusted, then if we have to make an adjustment for it, if the books are closed, what we needed to do is whatever the correction will be, it will be net of taxes. So if it's a net of taxes, the amount technically should be 62,000. The taxes would be for the 12,000. The net of taxes is 50,000. So what you're going to do is you have to restate your beginning balance, and that's what is called a balance January 1st adjusted, and sometimes they call it a restated. So some solutions there you will see a restated. and then everything else is same. You have a net income, you have a dividends, and that's the balance, and this balance will go to your balance sheet. So this is where it will go to your balance sheet. Now, when we are going further, it's saying under IFRS needed a statement that shows changes in each component of the equity. So we have a shareholders equity. Under that shareholders equity, we have different topics. So under there, we have a, of course, retained earning. If you think about it, it's saying total comprehensive income amount attributed to owners and non-controlling interest, effects of retrospective application of each component, reconciliation between the carrying amount and each component of the equity at the beginning, at the end, period, profit or losses, OCI. So in other words, these are some of the component that goes under the statement of the equity. So when we, this is sort of an example of what goes under the heading. So these are some of the things that goes under the consolidation statement of equity. You have share capital, you have contributor surplus, retained earning, foreign currency gain and losses, any assets that are available for sale. You have total interest, and then from there we have a non-controlling interest, and then from there we could figure out what was our total equity. Non-controlling is sometimes we have a subsidiary, we have a control of it, and sometimes we have a non-control over it. Sometimes we own less than the controlling interest, then it's called the non-controlling interest. When we talk about disclosure, so when we talk about disclosure and analysis, notes are a great source of background and explanatory information. Disclosures are always important because if we have notes in our with our numbers, we have to provide no a disclosure to the financial statement explaining the background and the background source of the background, where we got the information, so that we can cross reference them in the main financial statement. Those disclosures comes after the financial statements are at the bottom of your financial statement, so they are connecting the like footnotes, they're connecting to the main statement. What policy the company is using, what are some of the uncertainty they have, information about the capital of the company and how it's managed, and general information about the dividend, legal form, and country of incorporation, where the company is incorporated, description of the business name and the parent company, and other information as required. So those are some of the disclosures when we're talking about it. We also have to disclosure in the analysis. In the analysis, financial analysts and investors assess quality of the earning. When they assess quality of the earning, they look at these things. That's what they are analyzing. Accounting policy, are they using aggressive policy or a soft number policy? They analyze they analyze the notes to the financial statement. Is there some of the liability that is not recognized, or their assets are overstated? They measure the uncertainty of a risk, means some of the amounts that we put it in as a estimates, they look at that. And remember, when we did the fair in chapter 3, when we do the fair value, there is probability of the cash flow, that's uncertainty, there's a risk, they look at that. They look at the financial statement as a whole and the income statement percentage of net income from the ongoing operation. They also look at it, what from the net income, they look at which percent of the income is from the continuing operation, which one is from the discontinuing operation. They look at the cash flow statement. They compare your cash flow statement to the net income to see what are some of the cash items, what are some of the non-cash items, and what goes into our 3 of the activities that we have under the statement of cash flow. Now, this is just going back into the disclosure. Non-GAAP earnings means if something is non-GAAP, a measure of earning consisting of deducting from the net income non-recurring or non-operating items. If you put on something on your earnings and it's a non-GAAP, so then what we have to do is you have to a measure of earning consisting of deducting from the net income, and you have to deduct it from your net income. Earning before tax and depreciation and amortization. Earning before interest. EBIT is earning before interest and tax, and then DA is a depreciation and amortization. Those two are, if you think about it, depreciation is a non-cash items, amortization is a non-cash item. So that those are some of the things that we deducted it, but they're not making any difference. They're non-cash items. They are part of the expenses, but they're non-GAAP earnings. So they're non-GAAP earnings. Allow analysis of operating performance without effect from the financial interest, government tax, and accounting depreciation. So when we think of a non-GAAP earnings, it allows the company to present the interest we pay to the financing company, tax we pay to the government, CRA, accounting, we do depreciation. So it shows the performance of the income statement from the non-GAAP earnings point of view. This is just showing you the comparison under the IFR and ASPE. And this one, what they're showing is the income statement presentation. They're showing you some of the guidance of how to classify the expenses, the discontinuing operation, what they call each one, held for sale, liability reclassified as a current, other comprehensive income, earning per share, change in equity, and accounting changes. So those are some of the comparison between the ASPE and IFRS. This was chapter 4. I will do another recording to cover the questions at the back of the chapter. Thank you for listening to me. Take care, and I see you guys in the class.